Just looking at Alibaba stock price over the past year, it's down 18%. You'd think that this company is not doing something right, that either their revenue or their profits are not hitting targets or they're decreasing and the company is getting smaller. But in fact, the absolute opposite is happening. This is the annual performance from 2017, around 175 billion versus this past year in 2021, they did 717 billion in revenue. Okay, so that's about a 3 to 4 times increase in revenue. Yet in the same period, this stock has only doubled since 2017. Not even, depending on where you look at. So we're going to be talking about it and why Alibaba is my largest holding in my portfolio right now. Welcome back to the channel. My name's Adam, and here is my position. We'll get into it right away in Alibaba. I actually have two accounts. One is Wealthsimple, one is DiDi, and they're both TFSA accounts. So the first one, I have 10 shares. Cost basis was $241. And of course, I'm down by 14% or $354. So that, of course, kind of hurts, especially since that's my largest holding in that portfolio. And I have another two shares currently down by 0.1% or 42 cents in my Wealthsimple portfolio. And my other Chinese stock is Baidu, and I'm down by 3% there. And I have three shares in my Wealthsimple account there. And I have no shares of Baidu in my DiDi TFSA. Okay, so that's my portfolio. In terms of Alibaba stock. Of course, I'm going to be holding it. I think this stock should at least be valued at $400 to $500 in the near term, if not more. And long term, I see this being a $1,000 plus stock. Okay, this company has so much potential, and I think that there's a lot of short-term fear in the market that's not allowing Alibaba to be able to achieve the stock price that I think that they deserve. Okay, and part of it is the fear around DiDi and the overall market sentiment, where China's starting to crack down on these internet tech companies. And we can see DiDi, they just went IPO in New York a couple of days ago, and there was one huge drop that went from $15 all the way to under $12 in a 24% drop in one day, and that was ridiculous. And that was because China said that they wouldn't allow new app downloads of DiDi on different devices and different systems. Okay, and so that this will basically slow the growth of DiDi, and there's a lot of fear that potentially DiDi could get delisted. And what happened with DiDi is that DiDi actually went ahead with the IPO, even though the Chinese regulators said, wait, hold on a minute, we want to look at your financials more closely, et cetera, et cetera. And this article right here actually explains it well, where China is considering closing the loophole used by tech giants for US IPOs. And we can see Chinese companies that listed in the US this year sink in the wake of the DiDi crackdown. And Alibaba and Baidu were definitely on here, just maybe further down. Baba, I think, was down by like 4%. So this is very important here. So regulators in Beijing are planning rule changes that would allow them to block a Chinese company from listing overseas, even if the unit selling shares is incorporated outside China. This basically means that a lot of the companies' unit selling shares are headquartered in the Cayman Islands in the Caribbean, which they don't necessarily need Chinese approval before being listed on the New York Stock Exchange, but they're planning on closing that. And I actually think that this is potentially a good move because, for example, DiDi, their reporting practices are not in line with US accounting standards. And so basically, I think what China is trying to do is just, one, maybe not only to rein in these tech giants, but to also make them be up to standard for accounting practices in China and the US. So the Regulatory Commission is leading efforts to revise rules on overseas listing that have been in effect since 1994 and make no reference to companies registered in places like the Cayman Islands, said the people asking not to be identified. Once amended, the rules would require firms structured using the so-called variable interest entity model to seek approval before going public in Hong Kong or the US, the people said. And what does this have in relation to Alibaba, which is already listed in on the New York Stock Exchange? Well, under the revised rules, VIEs, so variable interest entity, like Alibaba that have already gone public may need approval for additional share offerings in the offshore market, according to people familiar. So what this means is that in order to raise additional shares, basically to dilute shareholder value or to just like raise money for more operations, they will have to go through the regulatory commission in China. But since they're already public, nothing is necessarily going to happen to the existing shares. So I actually see this as a benefit. I mean, one, Alibaba has a shit ton of money. They're not going to need more money down the road. And number two, that means that they're not, if they won't be allowed to sell more shares, that's okay, because they're thinking of buying back shares, which will increase shareholder value, and two, won't dilute my shares anymore. So I think this is not a bad sign. And I mean, I don't think we have to worry about Alibaba being delisted. And this article in May 22nd, 2020 said that Alibaba executive tells investors not to worry about China getting delisted from the NYSE. And a big issue surrounding this is that if Alibaba gets delisted from the New York Stock Exchange, then a lot of investors won't be able to invest in sort of like hedge funds and companies like that. Like insurance companies won't be able to invest in Alibaba because certain hedge funds are only limited to the pile of stocks that are listed on the NYSE. They won't be allowed to trade stocks that will be on over-the-counter markets, for example. And if Alibaba gets delisted and becomes an over-the-counter stock, then a lot of money will pull out of China from these big investors. But this Alibaba exec tells investors not to worry about that. And the main thing here is that Alibaba won't get delisted because the accounting practices that they've had are in line with US standards. So during the company's earnings call, Wu also proactively addressed investors' concerns over delisting risks, heightened this week by the US Senate's unanimous passage of a bill that would delist Chinese companies that are not accessible to the Public Company Accounting Oversight Board's audits after a period of 3 years. We're closely monitoring the developments of this bill. Investors should also know that there has been ongoing dialogue. Alibaba's financial statements are prepared in accordance with US GAAP, and now that's key. And because they're prepared in accordance with US GAAP, they have much less of a chance of getting delisted. And again, I don't think the US wants to limit access to investors being able to invest in China, which is one of the fastest growing economy in the world. So and the integrity of Alibaba's financial statement speaks to itself. So I don't think that Alibaba has a very high chance of getting delisted. Of course, that's always a possibility, especially if US-China tensions rise. But when you look at the fundamentals of Alibaba, it's just too hard to ignore, which we're going to go over very soon. So, but right now, a lot of investors are fearful, and as China's tech crackdown widens, investors may take a sell first, talk later approach. So a lot of hedge funds, a lot of insurance companies that hold a lot of power, they're selling their shares in Alibaba in sort of this approach where you just sell first and then you talk about it later because of the regulatory risk, of course. Okay, so a lot of people are risk averse and are just selling their shares without actually looking into the background, just because they think it's a huge risk. So the selling will continue in the third quarter, says Paul Pong, managing director at Pegasus Fund Managers. He says he sold 2/3 of his tech stocks holdings, including in Tencent and Alibaba, in May. The measures from the authorities will keep coming. And I mean, this is a very pessimistic stance. Again, I don't think China wants to do this to limit the success of Chinese tech companies, which are like the darlings of China right now. Okay, China wants to be seen as this sort of very powerful country where a lot of good things come out of. Okay, and if they sort of axe Alibaba, they axe Tencent, they axe Baidu, this will make them look weaker and will actually weaken the economy. Okay, so it won't be good for business. So my stance is that they're doing this for the best interest not only of the Chinese Communist Party, but for the best interest of the long-term success of Alibaba. And that's just my take. So again, investors are likely to take a sell first, talk later approach to limit policy risks in their portfolio. And a lot of people are following suit. But again, my advice is just be fearful when others are greedy. And this is the perfect time. From the Intelligent Investor, one quote that sticks out is like the intelligent investor gets interested in big growth stocks, so hence Alibaba, not when they are at their most popular, but when something goes wrong. Okay, and this is definitely when something is going wrong. And I mean, just to show you the growth of Alibaba, well, for one, they have a trailing P of 24, a forward P of 17. A forward P of 17 is incredibly low for a company that's growing, expected to grow 30% in 2022 and 20%, that's double-digit growth in 2023. And for a company already the size of over $500 billion, that's huge growth. Even when you compare it to something like an Amazon or an Apple, I think Apple's growing like 13% or whatever, and they have their trailing P is like 30. Amazon's P is like a 40. Whereas Alibaba's PE right now, I mean, you're looking at it and it's a 24. So this is a ridiculously cheap valuation for a company that has been solidly growing its revenue from 2017. They also got hit by a fine that was about 4% of, I think, their total profits in 2021 based on their antitrust allegations. But again, this is just a drop in the bucket. So if you ignore the short-term noise in Alibaba, you will profit tremendously. Of course, that's just my opinion. Please do your own due diligence and don't just listen to a guy from internet because he likes the stock, although I really do like the stock. And I mean, you can see the same thing happening in 2018. So let's take a look at the stock price in 2018 for Alibaba. From its peak, which was around $208, right now it's trading at $206, and it was like higher in 2018. I think that's ridiculous. And again, you look at like their fundamentals, how they grew. Like, they were doing just over 200 billion. Now they're doing over like 700 billion, and the stock price is higher 2 years ago. It's just, you know, like, come on, you know, this is ridiculous to me. So basically what happened in 2018 was there was a 30% drop, close to 40% drop in the share price over US-China tensions. So basically what happened, there were trade tensions and the tariffs on imports were increasing, and this basically was short-term noise that was affecting Alibaba's share price, and that's why it went down by over 30%. And I mean, when this article was written, November 16th, 2018, Alibaba, I guess, was down only 10% in 2018. So I mean, you know, this is just a sign. To me, this is just like, these things happen, okay? And I mean, right now, a similar situation is happening. So it declined by 36% from its peak. This stock is down by 33%. It might go a little bit lower, but even if it does, I just think that's a buying opportunity. And again, if you just ignore the short-term noise, be fearful when others are greedy, and find an opportunity in a high growth stock at a very attractive value right now, you could be looking at a nice 1 to 5x return on Alibaba Group holdings, and that's why I own this stock over something like an Amazon. So I'd appreciate a thumbs up if you enjoy the video, as well as if you haven't subscribed to my channel, please do so. That really helps out my channel. And leave a comment down below whether or not you own Alibaba, whether you're thinking about Alibaba. I'd love to hear your opinion on that. And feel free to check out the Discord group down in the link below, as well as to Wealthsimple. You could get 2 free stocks valued up to $4,500 if you're in Canada. And if you're looking for that for zero commission trading, definitely check out Wealthsimple. I think that's it for me. If you're interested to see my buys and sells in real time, please be sure to check out my Patreon. It's about $5 a month, or join my channel if you just want to support me and say hi. So yeah, take care, and I'll see you in the next one. Love you.